I'm Attorney Lynn Johnson. I'm the moderator for the night. I want to welcome you guys to the third in our 8-part series of free legal seminars sponsored by the Genesee County Bar Association. I want to introduce our panel members as we go along. You guys just wait because you guys didn't necessarily sit down in the same order. First we have Bill Fowler, who is an assessor for the city of Flint, where he has worked since 2004. Prior to that, he was an assistant administrator, property tax division. He was assistant administrator in the property tax division for the Michigan Department of Treasury. Then we have Attorney Joseph Cups. He's an associate with the law firm of Weingarten, Haley, Linden, and Robertson. Joe's practice focuses on representing taxpayers in the appeals of assessed real property, personal property, sales and use property before the Michigan Tax Tribunal, among other areas. He's graduated from the Michigan State University College of Law in 2005 and is a member of the Genesee County Bar Association. Are you guys waiting as I'm going along here?
We were.
Okay. Linda Poley is a lawyer who has worked in Genesee County since 1983. She lives in Flint and works in Flint Township. Linda is a graduate of Kalamazoo College and the Boston University College of Law, and she earned a Master's of Law in Taxation from Wayne State University. Linda practices in the areas of estate planning, probate, tax, and business law. And last but certainly not least, we have Attorney David Salem. He is a partner with the law firm of Hicks, Schmidlin, and Salem, PC. He represents and litigates on behalf of corporations of all sizes and their shareholders and subsidiaries, and he provides wealth and tax planning as well. His cases include representation of many professional corporations with respect to general business issues, billing issues, independent wealth planning, and litigation of shareholder-related matters. He's worked as a trial and advisory attorney in the Office of the Chief Counsel for the U.S. Treasury Department, advising IRS on large-scale corporate tax issues such as mergers, acquisitions, and international taxation, and was lead audit counsel over large corporations based in Michigan. He holds a BBA in Finance, Economics, and Political Science from Western Michigan University, and a JD from Michigan State School of Law, as well as a Master of Law in Taxation from New York University School of Law. I want to make sure that while we're going along here, that we thank the Public Library for providing us with this facility and the equipment, and the Genesee County Bar Association Foundation for underwriting the cost of the seminars, and the legal services of Eastern Michigan for partnering with the Genesee County Bar Association. After we're finished, the staff is going to collect a short survey from each of you, a ton of everybody, and then what we're going to do is we're going to have each of the speakers speak, and then we have about a half hour for questions after they speak. So we're going to start out with Mr. Fowler. Thank you.
Thank you. Good evening.
Good evening.
As stated, my name is Bill Fowler. I serve as the assessor for the city of Flint. I have approximately 30 years in assessment administration, both at the local, county, and state level. But tonight we're going to concentrate on property valuation and taxation as it affects the individual property owner. It is the duty and the responsibility of my office and my department to evaluate and value the taxable status of each individual property, both real and personal, located within the city of Flint. We have approximately 61,000 parcels that we review on an annual basis. Now, we don't physically inspect every one of those 61,000 every year, but we are charged with the responsibility of setting down a valuation that is reflective of 50% of the market value of the individual property. The city is comprised of 3 major classes: residential real, commercial real, and industrial real property. And we also have personal property, which is assessable for commercial, industrial, and utility properties. As you all have experienced within the last couple of years, property values have been declining, not only in the city, in the county, but statewide and now nationally. We are experiencing double-digit reductions within the city of Flint. The last 3 years, our property values have dropped 22% overall. This year, we will experience a 24% reduction in property values within the city. 24% to residential properties, 9% drop to commercial properties, and an overall 5% drop to non-GM industrial type properties. Basically, our market value is dropping. How does this impact the individual? Individual properties will also be dropping. Their individual taxable values will also be dropping. The taxable value is the basis for which property tax are levied. In the calendar year, we project and evaluate each individual property. Come around Valentine's Day, we are required to give notification to each individual property owner of the upcoming valuation for their property. Now, on your sheet in the handout, you'll find a handout that's called "This is not a tax bill." This is a valuation change notice. Okay? We are required annually to provide notification to those properties in which the valuation, be it assessed, equalized, or taxable, is changing from the prior year. As a property owner, you will receive this notification for any and all properties that you own. The notice will identify you as the owner of record. It will also identify the individual property of record. You'll find that we have blacked out to protect the innocent, the individual who owns the property, and the property address in the first two boxes. Of importance to you when you're reading this notice, next thing is your classification. This particular property is classified residential improved, which means it's a member of the residential real property classification and improved by some type of structure, be it a house or a building, but it is not a vacant piece of ground. This is the first thing that the individual should be looking at. Am I properly classified? Is my property actually residential? Or is it commercial? Or is it industrial? This is an appealable characteristic. If you do not believe that your property is properly classified, you may appeal that classification. The major portion of the notice is the valuation. You'll find lines 1 through 5 boxed off. It gives you notification of the prior year valuation for your property and the current proposed valuation for your property. This year we're comparing the 2010 to 2011. On this particular property, the taxable value is $23,500 for the prior year, and the resulting 2011 taxable is a decrease to $19,700. It notes some change, a minus $3,800. This particular property is a reduction of 16% overall. We also, on bottom line 2, identify the assessed value. The assessed value represents 50% of what we believe is the market value of the property. So on this particular individual property, the projected market value is $47,000. Now, we go through a system of checks and balances. At the local level, we make the assessments. Our assessments are reviewed by the county, and the county's work is reviewed by the state. We come up with the final determination of the state equalized value. Since 1994, property taxes have not been levied on state equalized value. Property taxes have been levied upon an individual property's taxable value. An individual property's taxable value is restricted constitutionally. An individual property cannot increase in value, taxable value, by more than the rate of inflation or 5%, whichever is less. Now, in this being a decline in value, that particular provision does not hold. It takes the low water mark, so the taxable value is set equal to the assessed as equalized. So your concern should be as to what your value of your property is. Is the city or the municipality correctly valuing property? Do you believe that your property is worth the stated value? Another thing that we look at is properties that have sold. There is a pop-up clause within our Constitution and within statute. The year following the transfer of ownership, a property's taxable value, be ever how low it is set equal to the state equalized value the year following. If this property had had a taxable value in the prior year, let's say of $17,000, and we project that the new taxable value should be, assessed value should be 19, it would pop up to the higher level. Okay? So we also have to make a determination as to whether or not there's been a transfer of ownership. Another issue that's reviewed for the general public, and that is the principal homestead exemption. Individuals who own and occupy their property as their principal residence have an entitlement to an exemption. That exemption is of the 18 mil school operating levy. That is approximately 1/3 of the tax bill that could be levied within the city of Flint. So whether or not, do you have a homestead? If you have a homestead, you might have 100% exemption. You could have a percentage less than. If it's not your principal residence, then you'll have 0 as highlighted in the yellow. This is also an area that you would have concern of. You must own and occupy the dwelling as your principal residence as of May 1st of the calendar year. So as we go into 2011, individuals who own and occupy their home as of May 1st, 2011 would have an entitlement to this exemption. Now, at any point when you're going over this document and the red flag goes up and says, I don't agree. What is my due process? What are my rights? On the document, highlighted in green, it tells you that if you are in disagreement with any of the numbers on this particular form, that you've been notified of the valuation of your property, you have the right to appeal. Within the city of Flint, by ordinance, we meet the second week in March. And this year will be March 14th, 15th, 16th, and 17th. The Board of Review, made of 9 members appointed by City Council, will meet in session to hear public appeal. On the 14th, we will be in session from 10 a.m. to 4 p.m. On the 15th, the Tuesday, we will be in session from 3 p.m. to 9 p.m. On Thursday and Friday, the 16th and 17th, we will be in session from 10 a.m. to 4 p.m. to hear public appeal. It is the role of the Board of Review to entertain your appeal and listen to your concerns, your arguments, and your proof as to your contentions of value on your property. The burden of proof rests with the property owner if they are in disagreement. If you come in with your hat in your hand, you will leave with your hat in your hand. The burden of proof rests with you. My 15 minutes is up.
This is 620. Actually, the next speaker is Attorney Cups, and he's going to address property tax assessments and appeal processes.
Good evening.
Good evening.
My comments tonight are basically, as you were just told, going to address how to appeal your property tax assessment if you disagree with it. Mr. Fowler just a few seconds ago briefly touched on the process for appealing your assessment to the Board of Review. I'm going to expand on that just a little bit, and then I'm going to talk about the next option after the Board of Review, if you don't get a satisfactory result. As Mr. Fowler noted in his presentation, sometime after the first of the year, you'll get a copy of that notice of assessment that he provided you with. There's no particular requirement for when you actually do receive that notice of assessment. The only requirement is that you receive it at least 10 days before the first Board of Review meeting that's held. Typically, as Mr. Fowler noted, usually about Valentine's Day or sometime as late as early March. As he also noted, if you disagree with that notice of assessment, the first step is to make a protest to your local Board of Review. Mr. Fowler told you about the dates for the City of Flint Board of Review. If you don't happen to live in the City of Flint, that notice of assessment will still tell you the exact dates when your city, township, or village will hold their Board of Review meeting or meetings. Now, it's important that if you disagree with the amount stated in the notice of assessment, that you do make your appeal first to the Board of Review. If you miss that step and you don't appeal to your local Board of Review, you are cut off from any further appeals. There's nothing more you could do. And I would also, let me take a step back and say that my comments this evening are addressed to those of you who are appealing an assessment on your residence. If you're appealing an assessment on your business property, or for some reason, let's say it's industrial property or personal property, there are different rules. So what I'm telling you tonight only applies to residential property, your house. Now, the process for appealing to your local Board of Review varies. Some boards of review require that you appear in person. Some boards of review require that you make an appointment beforehand, before you actually show up. Some boards of review, it's basically just a drop-in session. You show up anytime during the stated hours. Some boards of review will let you make your appeal or your protest by letter. Again, there's specific requirements if you are appealing by letter. As Mr. Fowler notes in the notice of assessment that you received a copy of, an appeal can be made by notarized letter. Usually the signature of the homeowner or the party in interest is required. So make sure you pay attention to what that notice of assessment says for the specifics. The Board of Review is generally a panel of at least 3 individuals who have some kind of experience in real estate. Usually they're not going to be an attorney, but they have some general experience with real estate. Mr. Fowler did note that general pleas won't work. Just going to the Board of Review and saying that the economy's bad, unemployment's high, there's lots of foreclosures in my neighborhood, that's not going to cut it in front of the Board of Review. You need specific, concrete evidence to successfully appeal your assessment in front of the Board of Review. How do you do that? Well, what you can try and do is come up with comparable properties in your neighborhood that for some reason are assessed lower than yours. Again, they've got to be in the same neighborhood, they have to be generally the same size, they have to be generally of the same quality. That's persuasive. Another persuasive bit of evidence for the Board of Review is an appraisal, a recent appraisal as of December 31st of the prior year. For example, if you're appealing your 2011 property taxes, you would get an appraisal that was dated as of December 31st of 2010. That would be a very persuasive bit of evidence for the Board of Review. Another thing you can bring to the Board of Review is if you know specific facts about your property that maybe the assessor doesn't know. For example, maybe the interior is of a very inferior quality. Maybe there's something wrong with the actual kitchen cabinets, or let's say the basement is prone to flooding, or the foundation has a particularly large crack in it, things like that that possibly the assessor isn't aware of. Something that's important to do before you go to the Board of Review is go down to the assessor's office and make sure they have the right information about your property. make sure they have the right lot size, make sure they have the correct square footage noted in their records, make sure they have the right number of bedrooms and bathrooms, whether the basement's finished, partially finished, etc. Now, once you go to, well, let me back up again. When you appear in front of the Board of Review, you need to be very organized and you need to be very concise in your presentation to them. You need to know exactly what you want the Board of Review to know and why you believe the assessed value is lower than the assessed value that they've determined. So keep it organized and keep it concise in front of the Board of Review. Now, once you appear in front of the Board of Review, they have to let you know their decision no later than the first Monday in June. They'll do that by letter. It will tell you either that they have affirmed what was found on the notice of assessment or whether they've lowered your assessment. If you're not satisfied with the Board of Review's decision, then the next step for appealing your assessment is to the Michigan Tax Tribunal. The only way you can get to the Michigan Tax Tribunal, as I noted earlier, is if you appeal your assessment in front of the Board of Review. You need to appeal your Board of Review determination no later than July 31st. You do it after July 31st, you're out. You're out of luck. The July 31st deadline, according to the Michigan Tax Tribunal, is a postmark deadline. So as long as you drop it in the U.S. mail by July 31st of 2011, then your appeal is good. It's the appeal form to appeal to the Tax Tribunal. It's just a 2-page form that you can download from the Tax Tribunal website. It's fairly straightforward. You fill in your information and give a quick statement of why you believe the assessed value as set by the notice of assessment is incorrect. If it's your principal residence where you actually live, there's no filing fee to appeal to the Michigan Tax Tribunal. Otherwise, if it's, for example, a rental property or some other type of property, there will be a filing fee. Usually I recommend, and what I do in my own practice, when I send anything to the Tax Tribunal, I send it by certified mail, where you put the green card on the back. When it gets to the Tax Tribunal, they sign for receipt of it, and then you get that postcard back. The Tax Tribunal is very backlogged right now with people appealing assessments on their residences primarily. So things tend to get lost. Things tend to take a while to get processed. That green card you get back from your certified mailing is good evidence that it actually got to the Tax Tribunal and that it was sent when you said it was sent. When you fill out that 2-page form to make your appeal to the Tax Tribunal, it's important to fill in all the blanks. When you make your factual statement of why you believe the assessed value is incorrect, you make factual statements only about the property and your appeal. Each of those factual statements should be in separate paragraphs so that it's easier to read and that it's nice and concise. Typically, the appeal of your residential property tax assessment is in what's called the Small Claims Division of the Tax Tribunal. The Small Claims Division is much less formal than the full Tax Tribunal. It tends to be relatively quicker, and usually the Small Claims Division appeals, well, again, let me back up. The Tax Tribunal is based in downtown Lansing. It's in an office building down there. However, excuse me, when you make your appeal in the Small Claims Division, the actual hearing or determination of your appeal is typically made close to where you live so that you don't have to travel far, or sometimes it's even done by telephone, so you can just do it from home or work. As I noted, it's relatively informal. There's no court reporter. You don't get to ask questions of the, excuse me, the local assessing jurisdiction, for example, of Mr. Fowler or whoever he sends from his office to appear at that hearing. You don't get to ask him questions. And as Mr. Fowler noted, the burden of proof is always on the taxpayer. It's your job to explain to the tax tribunal, the hearing officer, why you believe that assessment is wrong. And as I noted a few minutes ago, the tax tribunal right now is very backlogged with cases. If you filed your appeal by the July 31st deadline of this year, it's probably going to be about 9 months to a year before you actually get a hearing on your assessment. Although the tax tribunal, about a year and a half ago, they did hire extra hearing officers, so they're starting to work their way through some of that backlog. Once the hearing officer hears your side of the case and hears the local assessor's side of the case, the hearing officer will issue a written opinion that has his or her findings. You'll get a copy of that in the mail, and you'll take a look at it. If you notice any obvious errors in that written proposed opinion, then you can file objections, or as they call it at the tax tribunal, exceptions to the proposed opinion. You have 20 days once you get that proposed opinion to file your exceptions or your objections that know what you think is wrong. If you don't file any exceptions, then that order will become final. If you do file exceptions, then the hearing officer will take a look at them and go from there. Now, one thing that's important to consider, it's not such a big deal with appeals of assessments on your own house, but it could become an issue. If the case drags on long enough at the tax tribunal, you might need to file a request with the tax tribunal to add next year's taxes. For example, if you disagree with your 2011 tax assessment, you appear before the local board of review, you don't get a satisfactory answer from them, you file your appeal with the tax tribunal by July 31st of 2011, maybe they haven't gotten around to hearing your case by July 31st of 2012. If that's not happened, then you need to appeal your 2012 taxes also and add those to your pending tax tribunal case. So my point is, if it drags on long enough at the tax tribunal, be aware of adding next year's taxes if you're not happy with the assessed value. Now, if you're still not satisfied with the tax tribunal's opinion, officially under Michigan statute, the Tax Tribunal Act, you can still appeal to the next level, which is the Court of Appeals. In practice, though, because of the filing requirement, the filing costs, most people, the vast majority of people, don't appeal that far. But if there is a substantial amount of issue that you're arguing in the assessed value, just be aware that the Court of Appeals is the next step, and it's always an option. If any of you have questions, I can answer them at the end. Thank you.
Thank you, Attorney Cox. Our next speaker is going to be Attorney Foley, and she's going to talk about handling and dealing with the IRS problems in general.
And then could you do this? I brought a outline. Sure. Thank everybody for coming here tonight, and greetings to those of you who might be viewing on the internet at some time in the future. We're very happy to have you here tonight. About 6 weeks ago, 8 weeks ago, Deborah called and said to come and talk at our Ask the Lawyer meeting. I said, sure, why not? It'd be fun. And we talked about things I might talk about, and we kind of came up with this handling problems, which seemed like a nice thing to talk about. And so I thought about it for about 5 minutes and then went on with my life. And when I sat down and started thinking about what I was going to talk about today, I realized that I'd bitten off a great big chunk, because there's a lot of problems that can come up with the IRS. Very complicated, our tax system. Lots of ways to cause problems for yourself, and in 15 minutes, I'm not sure I could explain the difference between an innocent spouse and an injured spouse and why you care. So to get into the details of how to solve various problems is really a fool's game. So I started thinking about the things that I could talk about that were kind of common themes in the tax matters I've handled over the years. And I found kind of the same patterns developing. And those of you who are here might say, well, gee, that's common sense. Where's the punch? But people are funny, and they make sometimes mistakes because they have violated common sense. So, if you have a problem with the IRS, the first thing you have to do is take a deep breath and say, what is the sensible solution to this problem? Now, of course, the first desirable approach is to avoid problems altogether. And the first bullet point of my outline is, not surprisingly, obey the law. Now, that is not an easy task. The tax code is extremely complicated. I imagine after 30 years, I carry around about 3% of it in my head. Everything else I have to look up. David's way smarter than me. He's probably about, what, 5%, David, would you say? You know, I mean, it's very hard to understand, even if you are highly educated, in the IRS tax code, what the particular outcome of a particular situation might be at any given time. So, you have to look it up sometimes. The instructions are good. Read them. I don't like to read them either. But they made a big effort in the last 10 years to make them readable in English and everything. So if you take the time, if you're looking at your tax form and you don't understand what they're asking for, go look at the instructions. There is an excellent program here in the city of Flint. They call it VITA, Volunteer Income Tax Assistance, offered here at the Flint Public Library. They start in February. It is for lower income families. Your family income must not be more than $49,000. And the telephone number is 810-249-2569, and they will be glad to tell you whether or not you can qualify for this help. And if you're having a problem, they'll sit down and help you work it through. The earned income credit in particular is more complicated than it should be, and they know the rules on that pretty well. Second, and I do this probably 4 or 5 times a week, the IRS website is excellent, and they have very, very good publications. And sometimes it's easier for me to find the answer I'm looking for in an IRS publication than it is in the paid tax service I have that's supposed to give me all the answers. If that doesn't work, you can call the IRS. And most of the time they'll give you a good answer. If it's really an unusual situation, they might miss, but usually they give you what you need. And their phone number for individuals is 1-800-829-1040. And if you still can't figure out what you ought to do with a particular situation on your taxes, you should hire somebody to figure it out for you. And there are a number of very, very capable accountants. You don't necessarily need a lawyer. Maybe you do. Maybe if it's really unusual or there's a lot of money involved, but an accountant or a tax preparer, qualified tax preparer, there's something, don't know what they're doing, probably will be able to answer your question for a relatively modest fee. It says in the outline, your barber probably is not your best tax advisor. And I mean that sincerely. Everybody's got some idea about how you can save money on taxes. Don't listen to them. They just haven't got the call or the letter. They might have been able to write themselves a nice little tax cut by doing something screwy on the tax return. But they're not going to be there when the IRS is asking you to show up for an audit. And finally, keep the politics out of it. There is a very good case to be made as citizens for reforming the tax code. Write your congressman, call your congressman, write a letter to the editor, join a group. But don't say this is an unfair system, so I'm going to make it fairer for me. Because the IRS takes a very dim view of I'm thinking, and David, it hasn't been so bad for tax protest groups in the last few years, really, but they come and go. You know, every once in a while you get groups that run around telling people they don't have to pay their taxes, and if we all don't pay our taxes, then what are they going to do about it? They're going to audit all of you. You're going to get in trouble, and they're going to hit you with a bunch of penalties. That's what they're going to do. Don't get caught up in that. Don't do it. File your tax return. A lot of people are very apprehensive if they think they're going to owe money, so they forget about it. They put it under their pillow. I don't know. And they miss the deadline, and a month passes, and a year passes, and now they can't file next year's tax return without filing this year's tax return. And after a few years, they're in a terrible pickle, and they're miserable. They can't sleep. They can't, you know, their marriage is in trouble, and they're walking around apprehensive, and every time the phone rings, they jump out of their skin. Don't do that for yourself. Even if you don't have the money, file the tax return. Even if you don't have the money, file the tax return. If you can't get it in on time, get an extension. Get the information you need, file your tax return within the extension time. If they want your children's social security number, give them your children's social security number. They're not going to not notice, they'll be in touch. So get it and file it, and then you don't have to talk to them. And do keep copies of your returns. If you e-file, you know, you can print out the little e-filing receipt. And I think 5 years is about right at a minimum. It's longer than the statute of limitations, but how much room does it really take up to keep a folder? I personally think it's a good idea to keep them around for a longer time than that, because you might want to go back and refer to what your income was in 1982 for your own personal planning business. Next outline says pay the tax as soon as you can by any means necessary. If you can't pay your tax, chances are you have a bigger problem than not being able to pay your tax. Your business is living beyond its means, your household is living beyond its means. You have to address that problem, and you have to get the tax paid. Now, there might be an exception for that. Maybe you took a big distribution out of an IRA for one particular reason, and you have a bigger tax to pay than you normally would, and it's just a one-year problem. But still, it's a big problem when you do have to pay it. Get a cash advance on your credit card, go to your father-in-law, do whatever you have to do to pay the tax, because the last person you want to owe is the IRS. Now, if you can't, you can't, and there are ways around it. You know, they will work with you if you'll work with them, but they're not very nice to work with. I mean, they're good people. I'm not saying they're mean and everything, but their basic approach is, well, looks to me like you got some extra money. What are you doing paying private school tuition? What do you mean you have credit card debt? Got to pay your tax first. And they mean it, and they stick to it, and you do wind up paying a much higher monthly percentage than you would if you were paying on a credit card. So pay your tax. Be mindful. And what I mean by that is, before you do something that's going to have an effect on your taxes, stop and think. If somebody is telling you that the tax savings on the deal will pay for the deal, they are lying. Don't do it. Doesn't work. If somebody tells you that everybody is doing it and you're a chump if you don't do it, don't pay any attention to them. They do not have your best interest at heart. If you are taking a big distribution from your IRA and you are concerned that you won't have enough money to pay the tax come next year, then sit down, or if you can't do it, go to somebody who can, and figure out what the tax will be. Treat tax issues as important financial issues in your life, every bit as important as whatever rate of return you're getting on your pension savings. And you can avoid a lot of problems. And the final item is on the avoiding problems. And I say this at the end after everybody probably is afraid, but don't be afraid. If you have done your work, if you have looked at the law, if you've sought advice and you arrive at the conclusion that you're entitled to take a tax deduction or a tax credit, then take it. Don't worry about getting audited just because you're taking a deduction. That's why they're there. Congress passes laws that says you get a deduction if you're going to do this, and you do this, and then you get the deduction. If they say you get a credit for putting windows on your house with a this, and that VAT factor from an approved vendor and so on and so forth, if you've done it, take the credit. Did you make something on the radio?
No, you said it was a final item, but there was a final item, so I was just.
Well, no, I got a whole nother page.
Okay.
And I had avoiding tax problems, now we got resolving tax
Good.
problems.
Good.
Okay. Resolving tax problems. Sort of a corollary of don't be afraid is don't panic. You get a letter from the IRS, and I have gotten them, it is a little bit intimidating. I didn't get in trouble, I just, probably 10 years ago, I took a credit that I really wasn't entitled to. And I get home and on the table there's this letter from the IRS. Oh man, I didn't know what they wanted. I opened it up and they basically said, "Hi Linda, we see that you took this credit. And we don't think that you're entitled to this credit because of this. And maybe we're wrong, and if you really think we're wrong, then why don't you just tell us how we're wrong? Otherwise, send us a check for $260. I went and looked it up and went, oh, they're right. I sent them a check for $260. And you know, when you think about audit statistics, you know, it's very, very rare to get audited. And a lot of the audits are just like that. We don't have enough information. Why'd you do that? Are you sure you're really entitled to take that? You go back and take a look at it. If you had your return professionally prepared, you take it to the person that maybe screwed it up in the first place, said, here, fix. And they're supposed to, because they're supposed to stand by their work. And most of the time, not all the time, that's all it's about. It's complicated, you missed something, you misunderstood something, they want to fix it, it's over quickly. But in the 28 years I've been doing this work, I can't tell you the number of times I've had people come into my office with a briefcase full of unopened envelopes from the IRS. And they just, drop them on the desk, they can't face it, they're intimidated, they're scared, they got this big problem, they don't want to deal with it. And time after time after time, by the time they do get some help, it's way down the road where it's much, much harder to resolve the issue than it would have been if they just opened up that very first letter and dealt with it. The IRS is like anybody else, they don't like to be ignored. So don't ignore them if you get a letter. Second, if you get a letter and you decide that you don't want to pay money for a lawyer or a CPA or an old agent to help you work it out, and try and do it yourself, be nice. Be very nice. You don't have to ask them to see pictures of their kids or anything like that, but if you speak to them in pleasant tones, in a calm tone of voice, you don't call them names, you're way ahead of a lot of the people that they're dealing with. There are a lot of people who work for the IRS are very smart and they're very good and they know exactly what they're doing. And if you're going to get on the phone and start threatening them, boy, there's going to be in trouble, I'm going to call my congressman to see you, well, they're going to say, fine. I suppose I could have helped you, but I'm not going to, seeing you being so mean and all. And they won't. They don't have to. They'll just tell you this is what you have to do and you better do it or you'll be hearing from us. On the other end, if you call them up and say, I've got a situation here and I'd like to work it out, most of the time they'll say, okay, let's talk about it. Not all the time. I got a few stinkers, but not very many. Second, be patient. You're going to be spending a lot of time on hold. I think some of my clients hire me because they can't stand to be on hold. So they put me on the job. We have some numbers we can call sometimes to avoid that, but sometimes we spend time on hold. And it's frustrating and you get tired of it. But I just put it on speakerphone and do whatever it is I'm doing on my computer, and sooner or later somebody will pick up and talk to me, and you just try not to let it get to you. You have to make notes. Every time you have a contact with the Internal Revenue Service, If they're a legitimate Internal Revenue Service, they will give you their name and they will give you their identification number. Write it down, and the date and the time. And in summary, what they said and what you said, and what you promised to get them and what they promised to get you. And then put that date on your calendar. And if you said, I will get you the supporting documentation for this deduction by May 1st, then you have it there by May 1st. And if you can't get it because you can't get it from the people you need to get it from, then you call them before May 1st and say, I don't have it. I need another few days. And they put it in their calendar and everybody's happy. But if you just ignore it, well, then the computer kind of just takes over and starts shooting out the nasty letters again, and that's no good. So you just need to get the person on the other end of the phone to make an entry that you have, in fact, complied, and they've given you some more time. Be practical. They want to get the thing done, and you want to get it done, so before you call up the IRS, think about what you can do to solve whatever the problem is, and give them some proposed solutions. Don't expect them to solve the problem for you, because you're the one that knows what you can do. You know, and they're not going to sit there and say, well, can you pay $400 a month? No. Can you pay $300 a month? No, can't do. Can I pay $200 a month? No. Well, all right, how about $50 a month? Yeah, that I can do. That doesn't work that way. They want you to give them the information that they need to see what it's going to take to solve the problem. And you have to be realistic, because they have bosses too. And no matter how nice you are, you know, even if you do ask to see pictures of the kids, they're still going to have to explain why what you're proposing is in the best interest of the government. If you can't get the problem resolved, there are a number of ways you can address that issue. You can talk to their supervisor. Everybody at the IRS has a boss. You can talk to them if you ask nicely. There are many appeal rights. On the handouts that I gave you, there is Publication 5, your rights as a taxpayer. You have the right to appeal a lot of things that the IRS wants to do, and some of them can be handled without lawyers. And it's probably a pretty good idea. But it's worth a try, especially if it's a small amount and the amount at issue is less than you would pay for a lawyer to appeal it. There is a taxpayer advocate service which I have found useful on occasion. Their number is 1-877-777-4778. And they have people, they're a division of the IRS, but they're independent of the IRS, and they are charged with the responsibility of solving problems with the IRS. It could be something as routine for them as a refund that just hasn't gotten issued for a variety of reasons. They can help you out if you're dealing with an IRS employee who just is not responding to your concerns. I found them to be useful. It's worth a try. Something which works sometimes, and I didn't put it down here because it doesn't work all the time, is if you absolutely can't get anywhere with the IRS, try calling your congressman. Doesn't always work, but they do have constituent service people that can sometimes get to the right person in Washington who can get to the person who is either causing the problem or failing to solve it. And finally, you do need a lawyer if you have multiple years of unfiled tax returns. If you are in business and you have not paid your payroll taxes. If the IRS is threatening any action which would put you out of business or cause you serious hardship, although it'd be nice if you got some help before it got to that point. If anybody shows up who's wearing a gold badge and introduces themselves as a special agent, you really shouldn't talk to them. You should get a lawyer. And finally, if the situation is becoming frustrating enough to you that it is degrading your own quality of life, bite the bullet, get somebody to help you out with it. It won't be personal. They aren't going to lose any sleep over it. You turn it over to them, give them a budget to work with, and they can solve your problem, and maybe you'll sleep better at night. That's concluding my presentation. Thank you, Linda.
Thank you, Lynn. Our last speaker for the evening is Attorney Salem. He's going to talk about the tax implications of cancellation of foreclosed properties and dealing with the IRS tax liabilities.
Based upon what I've heard the other panel members discuss, I'd like to give you guys some flexibility as to potentially where you'd like this thing to go. Obviously, cancellation of debt may not be a concept that you're too familiar with, although you may be familiar with the ways that debt gets canceled. In your bags, there are a couple of IRS forms. There's a Form 656 and a Form 433A. The reason I included those along with the 1099-C is just to give you some guidance as to how the IRS handles issues similar to what Linda was discussing. That's the cancellation of debt side. The other side is, okay, well, once you have this debt canceled in your personal life, and the IRS explains to you that a debt being canceled is akin to income, and as a result, you owe us income tax. Which means if I lent you $100,000 and you paid me back $50,000, and then you dump the debt on the other $50,000, you've got a $50,000 tax bill coming. Obviously, if you couldn't pay the $50,000, how are you going to pay the tax bill, right? Foreclosures, credit card debt that's canceled, all these types of things give rise to 1099-Cs. Your principal residence, to the extent it's foreclosed, is not as major an issue as there's many tax benefits that can help you get around that. The major exception to a canceled debt issue is the fact that if a debt is canceled while you're insolvent, simply can't pay your bills, it doesn't mean you have to be bankrupt, but insolvent. You don't have as much money coming in as is required to maintain your life. Then it's not income. Under Section 108E of the tax code, it specifically says that if the debt is canceled at the time you're insolvent, it's not income, okay? That's one methodology. You can prove to the IRS that you're insolvent. The other methodology is simple. If you actually filed a bankruptcy, the IRS usually references that in comparison to the 1099 they get from the person who canceled your debt and also sent to you. And they simply say, oh, this person filed bankruptcy, it must not have been solvent. And they usually won't look for the 1099 or the amount of money claimed on your tax return as income based upon the 1099. So sometimes the IRS is intuitive enough to gather that. A couple things I'd like to say at this point that Linda brought up that I think are extremely important issues when dealing with the IRS, so I'll go over them again. One is, if it's affecting your personal health, get help. I've done so many different things with people. Some who couldn't afford to hire me, some who could afford to hire me. You see people come in your office, we're not inhuman. When people need help, we try and give it, even sometimes to our detriment. If it's something where I see somebody come in, I've seen shingles, Bell's palsy, heart attacks, I've seen death as a result of IRS issues. People so stressed out that they can't handle it. These are all stress-related illnesses. Divorce. I've seen things that families go through because somebody looks at something that's so complicated they just don't know how to handle it. Don't do that to yourself. Even if you can't afford to hire somebody, call somebody. Do something with somebody you know. Ask them if they know anybody who might give help. There's plenty of legal services groups in town. There's usually free tax groups that maybe they're not geared up to do that type of work, but they may be able to refer you to somebody. One of the things that I would caution on that Linda also mentioned, tax preparers very often have schemes that make it sound like you can do these wonderful things. If it doesn't sound right, it's because it's not right. Really heed that advice that she gave you. The other one is file your tax return. There's penalties associated with not filing your tax return that far exceed the value of not putting yourself on the radar sooner. Put yourself on the radar, file the return. The IRS deals with people all the time. You're just another number to them. I know that sounds horrible, but trust me, you'd rather be another number than have them specifically know who you are. There's processes. They're very standardized, and let your issue work within those processes. As Linda also stated, let that IRS agent help you, okay? There are, and as she said, there's 90% of them are good people. You come in there, and in this case, hat in hand sometimes works. Tell them, I don't know how to handle this. help me handle it. They'll help you get through it. These are not inhuman people. They're good people, okay? I happen to know the manager and many of these people personally at the IRS office. I deal with them every day. Been to their houses, met their families. They're good people just like you and I. One thing I will tell you, you fail to meet a deadline, you will fail with the IRS. When they give you a deadline for submitting something, when you're dealing with an officer, revenue agent, something like that, their employment, their work status, their employee ratings are all based upon the timeliness of their completion of your file. They don't care. Their paycheck isn't going to change if they don't collect from you, right? But if you don't give them the information on time and they can't close the file on time and they have to tell their manager that there's a delay, everybody there is in trouble because you haven't done what they asked you to do and you said you did. That's going to create a problem for you, okay? Stick to your deadlines, it's critical. The congressional request that she talked about, congressmen, when they submit a request to the IRS has 10 days to respond. 10 days. So if I'm at the IRS and I'm sitting at my desk and I get a congressional request, 10 days. You send me one, I've got 90 days to reply, and my reply to you may be, I got your letter, this is to let you know I got it, and you'll hear from me. So definitely heed that advice. Okay, now as it relates to cancellation of debt, most people get the cancellation of debt, again, if they didn't file bankruptcy. Let's say they walked away from, they got scammed by one of these mortgage guys. So they bought 3 or 4 houses based on some stated income loan scam, and they're renting them out, doing the thing that, you know, so many people did years ago, and they let the houses go back. It's not their principal residence, so they're going to have a tax issue. Or they dropped some credit card debt, and they got a 1099 that they didn't realize they were going to get. Now you've got it, and you can't pay, okay? In addition to that, you don't have the extra money, and you don't have an extravagant lifestyle. If you have an extravagant lifestyle, the IRS has standard expenses. It's on page 4 of the 433A. That expense report is the most critical part of dealing with the IRS. If you're an individual with a tax debt to the IRS, that's the first form they'll want, and you better darn well know how to fill it out. It's not an easy form, and you better attach everything at the bottom of page 4 because they'll ask for all of it. But if you do it right, this is your reference manual for the IRS to determine how to deal with you. The IRS will collect every dollar of every debt you have with them unless you qualify for one of the statutory bases for cancellation of your debt. Either there is doubt as to your liability, that's one statutory way the IRS can cancel your debt. If there's doubt as to liability, 99% of the time, you guys may not realize it, but you assess yourselves. You sign your tax return and send it in. Or you've been paid the money and they send you something and you don't protest. So you're assessed. There's no doubt as to liability generally. Doubt as to collectability is where the form comes in. Doubt as to collectability is 99% of the issues. There's one that Congress added years ago and they should just take out. It's effective tax administration because the IRS never walks away from a debt. I've never seen it. Just purely for equitable or fairness concerns. I literally represented a nonprofit council here in Flint that had an issue and couldn't have been more meritorious by way of the fact that they didn't pay their taxes and couldn't pay it because of embezzlement and everything else in the IRS. It's you lost the money. So don't expect them to forgive you because they feel bad for you. If they can't collect from you, this form 656 in conjunction with the 433A I gave you is their methodology for what they call an offer and compromise system. It's the bankruptcy equivalent of taxes, okay? Unless you've committed fraud, you will qualify for this process. The only way you won't is if you've had civil fraud or criminal fraud as a component of your tax debt, okay? Fill out the 433A. The IRS in the gray section on the side of page 4 at the top of the form shows where your income, monthly income and outflows are. That gray section has another side box to the expense side. That's because the IRS has expenses they allow in comparison to expenses that you have. If you're a family of 3 and you're living in a house that costs $5,000 a month, your mortgage and everything, the IRS is going to give you $5,000 a month allowance for a mortgage payment when you owe them money. They'll give you about $1,100, $1,200, which is fair enough. And they'll go right down the board with that. They're not going to let you drive a, brand new Cadillac around for $1,200 a month when you owe money. They'll give you $500 a month for a car. So they're not being at all unfair. They're just not gonna sit there and tolerate certain things, okay? Again, the 433A is something that the person that wants to collect from you is gonna want from you. If you want the IRS to concede a debt, then you have to fill that out and make an offer on the Form 656, okay? And the alternative, if you're just dealing with somebody and you want to make installment payments, the IRS agent downtown or somebody on the phone, as Linda had referenced, these people have a little bit more discretion. So when you send them the form and you show, I have a $3,000 a month mortgage payment, I don't like it, but I got scammed by some guy who said I could finance $300,000 and do, you know, bailout, refi, all this other stuff on a home equity line and put $50,000 in my pocket, now I owe $200,000 on a house worth $80,000. If you've got one of those deals, you cannot qualify for the offer in compromise because your mortgage is so big, but at the same time, the IRS agent will look at that and realize you're not going to sell that house anytime soon. So they may allow you to make an installment payment based upon what it looks like you can realistically document and afford to pay, so long as they file liens against all your stuff, so if you sell it, they get a chunk of it, and as long as that payment amount will get them paid off within a satisfactory time frame, 5 to 10 years generally. They like to see 3, but 5 to 10 years, okay? So in essence, a cancellation of indebtedness is not the end of the world. Either you're insolvent or something else happens. It's always strange when you get a 1099 for money you never received. And depending on your tax bracket or whatever else is going on in your life, money that you didn't anticipate having to spend to pay the tax on, it can be overwhelming, especially with this mortgage thing. We've seen 1099s where 20 to 25-year-old people come into my office with some mortgage guy that sold them 5 properties with a combined value of $400,000, and they don't even make $30,000 a year. And they get, you know, they walk away from the houses on advice of somebody, they get a cancellation of indebtedness 1099 for $200,000. The bank's not going to chase them for the money, but just that one form pushes them into a ridiculous tax bracket and causes a massive burden to these people, okay? So if something like that's happened to you, the only real ways to handle it are to call. They're going to want your financial information on the 433. Use the numbers that Linda suggested to call. Again, adhere to your deadlines, give them your financial information as she said. If they ask for a social security number, give it. If they want to know your spouse's information, even though your spouse doesn't owe the money, give it. As you'll see, how do they know what portion of household expenses to allocate if they don't know what your spouse earns compared to you? They don't, they're not. 99% of the time they're not evil people. They simply need certain information to document their record. Again, they don't stand to make another dollar more than their paycheck pays them every week if they get more money from you. So if you give them a reason to want to help you, and give them a reason to help you get through this problem, they'll do that. They'll not only help you get through the problem, but they'll want to help you if you give them a reason to. As Linda stated, if you walk in there defensive, aggressive, and claiming that you don't owe the tax and everything else, and this is, you know, ridiculous. Well, most people are ignorant of the tax laws. As Linda and I would both concede. I don't think, last I checked, there were 65,000 pages of code and regulations. I'm pretty sure we're ignorant too to some extent. So we're just happen to be a little less ignorant than the average person. But don't act like you know the law and you're going to tell an IRS agent what's happening. Be fair with them. If you really think you're getting the short end of the stick, if you really think something's going on there, ask to talk to a manager, talk to the taxpayer advocate, or go get help. Okay? I think that's all I have.